Good morning, welcome to CATEX TV. Today is Friday, July 18, 2014. My name is Matt Bernat, filling in for Frank Fortunato, who is away this week. The loss of Malaysia Airlines flight MH17 over Ukraine yesterday, July 17, will cost the aviation market hundreds of millions of dollars, impacting both the all-risk and war policies. Insurance Insider has learned that the insured hull value of the Boeing 777 was insured for $97 million. If the reports that the plane was shot down are verified, the loss will be borne by the niche aviation war market, which has recently been pummeled by a series of losses. Lloyd's insurer Atrium leads the relevant policy. The passenger liability will be borne by the all-risk underwriters, with Allianz the lead on the Willis brokered policy. Information on the nationality of the passengers is not yet known, but with the flight taking off from Amsterdam, a loss of $300 million or more is not inconceivable. Malaysia Airlines has now suffered two tragedies in the space of 6 months following the loss of MH17 in March. The loss of that aircraft is currently projected to all-risk and war markets in the region of $400 million. This blow to the aviation market follows 5 days of fierce fighting at Tripoli Airport in Libya, where airplanes with a combined hull value of $440 million are exposed. Information is extremely limited at this stage, but sources have tentatively talked about a loss in the $200 million to $400 million range. The vast majority of any loss is likely to end up with Catlin-led Libyan African holding company. Reports suggest that the flight MH17 which was carrying 295 people, crashed in eastern Ukraine about 50 kilometers from the Russian border. The flight was en route from Amsterdam to Kuala Lumpur. Fierce fighting between rival militias at Tripoli Airport in Libya has damaged a number of aircraft, and early estimates suggest that the niche aviation war market will take a loss of over $200 million. Sources said that Catlin leads the Libyan African Holding Company's insurance policy, with the placement filled out by Willis's African line slip. The policy covers Libyan Airlines and Africa Airways planes, with a separate March brokered policy covering two Barak Air Boeing 737s, which are stranded at the airport. In total, $440 million of aviation war limit is exposed. Talbot leads the Willis Africa line slip that will bear the brunt of the loss. However, Validus's Lloyd's platform chose to decline the Libyan African Holding Company policy, and the line slip was led off by drop-down leader Aegis, sparing major war market Talbot. Huge uncertainty surrounds the quantity of the loss. The extent of the damage inflicted on the planes is unclear. With the fighting ongoing, it is not clear when loss adjusters will be able to assess the airport and the planes that are stranded there. Sources have cited likely loss numbers ranging from $200 million to $400 million, but they stress that all of this is preliminary guesswork and nothing can be verified until the fighting ceases, so adjusters can get in and see exactly what has happened. Reuters has reported that the fighting between a militia in western Libya town of Zintan and a rival Islamist militia has continued today, taking the firefight now into a 5th day. Insurers have a right to give a 7-day notice to the assured to review a policy post-loss, with the possibility of a rate increase or the insertion of geographical exclusions. If a mutually accepted deal cannot be reached, then the policy can be canceled. It is believed that this process has been set in motion. The aviation war market, which has an annual premium base of only $60 to $75 million, has endured a very hard year in 2014. In late November 2013, LAM Mozambique Airlines Flight 470 crashed, inflicting a $41 million loss on the aviation market. The claim has been split 50-50 by the all-risk and war markets. But if, as is expected, the confirmation of loss is confirmed as pilot suicide, war underwriters will bear the full brunt of this loss. This was followed by a $100 million claim from the loss of Malaysia Airlines Flight 370 in March, which disappeared under mysterious circumstances, likely in the Indian Ocean. This again has been split by all risk and war underwriters, but can also ultimately end up being paid 100% by the war market. And last month, Jinnah International Airport in Karachi was attacked by militants, damaging 4 Boeing 737s, inflicting an estimated $25 million of losses in the Lloyd's-dominated war market. Ultimately, aviation war underwriters are likely to end up with a claims burden somewhere in the range of $300 to $600 million, burning up years of premium. Aviation war is an extremely volatile market. Until the last 8 months, the market had a benign loss experience since September 11, 2001, yielding huge underwriting profits and fueling major rate reductions that came to an end in the wake of the MH17 disappearance. According to aviation information website JACDEC, damaged planes in Tripoli include several Airbuses, a CRJ-900, all belonging to Libyan Airlines, as well as 2 Airbuses run by Africa Airways. After these 2 sets of claims for both the Malaysia Air and the Tripoli war losses, Peel Hunt analysts have issued a sell recommendation on Catlin shares following these losses. The loss of Malaysia Air Flight 370 will cost the aviation war market hundreds of millions of dollars, and the insured value of a Boeing 777 is $97 million. Atrium leads the war policy and is likely to pick up the $97 million hull loss on MH17. And it is likely some of the loss will make its way into the Lloyd's market, judging from disclosures included in the Q1 interim management statements. Amlin, Brit, Catlin, Hiscox, and Nove would be the syndicates that are exposed. Most of the claims were expected to be small, but for Catlin, which has suffered already a single large loss this year with 370, it is predicted they will take another big hit. The string of large losses from the aviation market has led to a change in underwriting forecasts weighted on the downside, but interim results for the Q2, which are due on the 8th of August of this year, should bring more clarity. Allstate Insurance has announced higher than expected catastrophe losses for the second month in a row, taking the total for the Q2 to $936 million before tax or $608 million after taxes. The U.S. insurance giant said that June 2014 catastrophe losses were $216 million pre-tax or $140 million after tax, a total that included a modest $2 million pre-tax charge to add to its prior period catastrophe reserves. The $214 million burden for the month itself came from 12 individual catastrophe loss events. Allstate had previously announced a $720 million pre-tax catastrophe loss for April and May 2014. The company added that non-catastrophe frequency and severity losses for the Q2 were below Q1 of 2014, which was impacted by severe winter weather losses. The June catastrophe total was above the $180 million estimate factored in by KBW analysts. Insured losses from Hurricane Arthur, which hit North Carolina on July 3rd, are not expected to exceed $250 million, according to catastrophe risk management firm RMS. Hurricane Arthur made landfall as a Category 2 hurricane on the Saffir-Simpson hurricane wind scale, reaching speeds between 154 and 177 kilometers per hour. The storm generated strong winds and coastal flooding. It then weakened to a Category 1 storm before making landfall a second time as a tropical storm in Nova Scotia, Canada. Arthur is the first hurricane to make landfall in the United States since Hurricane Sandy hit the United States in October 2012. It is expected that most of Arthur's insured losses stem from flooding. Flooding insurance is usually covered by the United States federal government's National Flood Insurance Program rather than private insurers. That is the news for today. If we have any breaking news, you can stay tuned to CATEX News, and we will be more than happy to tell you about it. Thank you for watching, have a nice weekend, and we will see you again on Monday.